Exxon just overtook Nvidia in market cap, a reversal unthinkable 3 months ago, and the reason traces directly to a war that may now be ending. As Trump prepared to address the nation on an Iran off-ramp, the Dow surged 400 points, oil dropped 8% intraday, and airline stocks posted their best single-day gains in months. United and American Airlines soared on the logic that cheaper fuel means fatter margins. But the rally has a fragile foundation. Gas prices have climbed 36% in a month to a national average of $4.06, diesel nearly 46% to $5.49, and consumers are already shifting behavior. GM is ramping pickup production to 6 days a week in Flint, yet EV sales collapsed 26% in February as buyers retreated to familiar combustion engines. The Strait of Hormuz remains the bottleneck. Trump insists it must be open and clear before any ceasefire talks begin, but Tehran has called his claims of a deal false and baseless. If the strait stays contested, oil supply stays constrained, and the relief rally unwinds. The real tell is GM's own CFO. Historically, it takes 4 to 6 months of sustained high fuel prices before consumers trade down from trucks. That clock started ticking a month ago. That same energy cost pressure feeding through gas stations is quietly being amplified by something entirely separate, the AI investment boom. Fed economists at the St. Louis Fed published a striking argument this week. AI hype is generating an inflationary surge whether or not the technology delivers. The mechanism is a classic news shock. Households interpret AI adoption as a signal of future pay raises and spend more today. Businesses interpret it as a productivity miracle and invest aggressively. Demand outpaces supply and prices rise. The numbers back this up. Total factor productivity since ChatGPT launched has averaged 1.11% annually, below the historical average of 1.23%. The gains have not materialized, but the spending has. Oracle just laid off an estimated 30,000 workers to fund AI data centers, while securing $16 billion in financing for a single facility. SpaceX filed confidentially for an IPO at a $1.75 trillion valuation, with Musk citing AI-powered space data centers as the thesis. Goldman Sachs reports that fewer than 19% of U.S. firms have adopted AI, yet those that have are saving 40 to 60 minutes per worker per day. The gap between adopters and laggards is widening, but the macro cost is real. The spending is hitting demand-side inflation now, while productivity benefits remain theoretical.
Markets are starting to price in the unthinkable, a Fed rate hike. Goldman laid out 4 reasons investors may be jumping the gun, but the direction of the bet is what matters. The dollar index dropped as de-escalation hopes reversed the safe haven bid, yet the underlying inflation picture has not improved. The S&P 500 has entered what Bloomberg calls a danger zone, with late-week trading sessions crushing returns in a pattern not seen since the last tightening cycle. The wave of evidence points toward a rate pause holding through the summer, but only if 2 conditions hold: Iran tensions actually de-escalate, and AI-driven capital spending does not accelerate further into an already tight economy. If the Hormuz choke point reopens and oil retreats below 70, the inflation argument weakens materially, and the hike trade unwinds. If it does not, and AI capex continues compounding demand without matching productivity, the Fed faces a policy trap: cutting into an inflationary surge or holding while growth deteriorates. The benchmark to watch tomorrow is crude. If WTI stays above $85 after Trump's address, the relief rally was a head fake. If it breaks below $80, the off-ramp is real, and the rate hike trade loses its foundation.